It is finally Fed week, and there's a lot of excitement in the markets about what's going to happen on Wednesday. Will the Fed finally raise rates in January, or are they going to wait a little longer? Joining me today is James Stanley from DailyFX to give us his expectations on what to expect from this meeting. James, welcome. First of all, what are you expecting on Wednesday? Are we finally going to see the Fed raise rates, or are they going to push off till March?
Thanks, Danny. It's good to see you again. If they did hike in January, it would take a lot of folks by surprise. And that would very much go against the grain of what the Fed has done ever since the global financial collapse. I remember back when I started trading, the Fed was often a question mark. There was the Alan Greenspan briefcase index about, a little over 20 years ago, where folks would look at the briefcase that he brought the morning of a Fed interest rate announcement to determine whether or not he brought enough supporting documents to validate the move, i.e. whether or not the Fed was going to hike. It was a big mystery back then. Global financial collapse happens, and then the Fed figures out, well, hey, one way to be really accommodative to markets is just to tell them the policy is going to be accommodative for a really long time. That works all fine and well in a loose and passive backdrop where the Fed's not anticipating raising rates. But I mean, this is somewhat similar to what we saw in the taper tantrum scenario about 6-7 years back, where when you're telling markets that you are going to raise rates, you start to freak people out. I mean, the bond market, for instance, if you have bond desks that are really long and, like say long dated treasuries, and then the Fed's talking about raising rates, well, automatically that's a principal hit to those bonds that are already in their portfolio. If the Fed does this slowly, it's not as much of a concern, but it's going to reach a point where those desks aren't going to want to hold paper that's going to be going underwater in a rising rate environment. And that's what led into the taper tantrum. What we have right now is almost an exacerbated case of that. The Fed said in December they're looking at like 2 to 3 hikes in 2022. Even that was quite a shift from the one hike that they highlighted in September. And so the Fed's basically been managing expectations through the dot plot matrix. There's no dot plot on Wednesday. There's no expectations that are going to be furnished there. I think what's freaking a lot of people out right now is the prospect of QT, or quantitative tightening. Because as we've seen inflation continue and continue and continue, I mean, just the most recent print that we had on CPI was 7%. We started to hear President Biden talk about this, saying that the Fed is going to get in front of inflation. We started to hear Treasury Secretary Yellen in front of this, saying that the Fed is going to handle inflation. So, I mean, it's almost taken on a life of its own at this point. But I think the big question to ask is the Fed willingly going to bomb these recoveries they've been building with very loose and passive monetary policy for the past 10, 11 years? I don't think so. I think one of the reasons we're seeing so much pressure right now is the prospect of a possible announcement of QT. But even if that happens, I don't think the Fed has to do it in January. I think that's something they could say for March. I think what we're going to see on Wednesday is the Fed prepping the backdrop for a hike in March. I think we're going to see a 25 basis point adjustment in March unless something goes awry. There's a lot of things that go awry here, especially with the moves that we're seeing in crypto. I mean, we're at the point in some of these technical moves we're going to start to take on like a fundamental importance. If you start to see some of these big funds getting hit with the declines that have been hitting across equities, crypto, and most other risk asset classes on the planet Earth. So I think the Fed's going to do what they've been doing, which is when they do tighten, they're going to be slow and very methodical about it. Maybe they mention QT in January, but I don't think they're going to make any formal announcements. But QT is, in my opinion, the big hammer. That's what ultimately did the Fed in their rising rate cycle in 2017, 2018. They hiked thrice in 17, 4 times in 18. But, really it was the quantitative tightening that freaks out bond market participants. And then that domino effect can roll into equities and other asset classes. But, if we're at a point where the Fed is going to start pairing bond holdings, then, you're going out to those bond desks and you're saying that the Fed's going to be working against them in 2 ways. One, they're going to be hiking rates, which automatically makes principal value on currently held bonds less valuable. And then they're going to be competing with them in the bond market by becoming net sellers, as they're not going to reinvest dividends of bonds that mature. I think that's the big push point. Is the Fed announce QT or not? And we saw this through December, right? December rate hike, Fed talks up 2-3 hikes in 2022. The S&P 500 just went up to a fresh all-time high. I don't think that's the big push point here. I think the market could absorb 2 or 3 rate hikes this year. I don't know that they could absorb 2 or 3 rate hikes plus QT.
Yeah, You're right, and I mean we've seen a lot in market expectations recently. You as you're saying, a lot of it is to push back till March. Not really any cement at the moment that we'll see much happen in January. We did see the move start in the bond market. It's been quite active recently with these expectations. That has now trickled down into equities, as you were mentioning. I know you've brought a few charts with you. Walk us through what you're expecting in this meeting. As a trader, how are you setting up for this meeting? How can you take advantage of the possibility of the moves in the market coming off what Powell and the FOMC says in the meeting in the next few days?
For sure. Yeah. So, I mean, I often go into these things with the outlook of a trader first and then an analyst, which is very different than a lot of other folks or a lot of my other peers that will look at this from like an analytical perspective and then try to pull the trades off of that. From a trader's perspective, I'm often looking for mean reversion, you know, especially with something like we have on the NASDAQ right now. The NASDAQ's off like 16% from the high that was set back here in November. I mean, just last week, we were holding within this bullish channel that has survived ever since the 2020 presidential election. It held the lows throughout 2021. And coming into last week, it was even holding support again until it eventually got the rug pulled out from underneath it. And it's just been a direct drop ever since. We had a little bit of support at 15K, and then it was a dead drop to 14. This, to me, feels a little bit overdone. Now, the NASDAQ is a rate-sensitive type of vehicle. But, you know, we're at the point where we got to start asking ourselves, how is the market going to pull in additional sellers when you have an oversold RSI after a massive move that's priced in a really short period of time with the backdrop of a Federal Reserve that has been loose, passive, and supportive for much of the past 12 years? I'm not buying the fact that the Fed's at the point where they're like, you know what, forget about it. Equity markets can fend for themselves. I don't think we're at that point. Now, I think what happened in the backdrop of COVID is something that we might not see again. The accumulation of an $8 trillion balance sheet. I think it was an extra 4 Ts that were added since COVID came into the equation. And that's what's building into all of those expectations for an announcement of QT eventually. But, you know, it dials back to rates markets. And it goes back to what I was just saying. Like, if we look at rates markets and the way that stocks had absorbed these runs in treasuries, right? Like last week we saw, and this is when the pain really started in equities. Last week we saw the 10-year note pop over this 1.77% threshold, going over 1.8. That's where the hammer started to drop at about a 1.8 yield on the 10-year note. Now, notice as we dropped, we started to see a bit of support playing in, but then that sell-off in equity started to take on a life of its own to where we're at right now. But, I mean, throughout the duration of this run in treasury yields, equity prices were holding up very well. You know, now there's an X factor going on, and that's why I think this is fear around a QT announcement that I don't think we're going to get yet. But, you know, the Federal Reserve has been very open with this. They consider the wealth effect, right? When you have stock markets going down, it almost takes on a life of its own, because people then feel themselves getting poorer, and then that impacts purchasing decisions. And that's exactly the opposite of what the Fed wants right now. And they've even talked around the game theory of this. Like, if the Fed sees an impending collapse, if they're going to go out and talk about that impending collapse, it makes it that much more likely, because the Fed is now talking about an impending collapse. So thereby they probably wouldn't do it even if they saw one coming. But, you know, with that said, I think this is a rates move. 1.8 seems to be that threshold that equities just cannot bear at this point. And on Wednesday, we're going to see how the Fed dances around QT. I think they're going to do something similar to what they did last time, which is playing it slow. They don't necessarily have to go from QE to QT and rate hikes. You know, I think a simple adjustment of 25 bips in March is going to start to reset the tables a little bit, especially if they open the door for another 2 or 3 in the second half of the year. But it's a rates move. So with that rates move, again, we could see that where the treasury yield gapped up past that 1.8. That was last week, right? We closed Friday here at 1.77. We opened up the next Monday at like 1.8. And that's, again, really where the pain started to show. You look at the NASDAQ 100 on the 18th. That's the day that we finally gave up that trend channel. Notice RSI is now more oversold. It's more oversold than it was back in the COVID scenario when that was getting priced in February 2020. To get that oversold, we have to go all the way back to Q4 2018, the last time the Fed capitulated on a rising rate cycle. And the way this one played in was really very interesting because, you know, again, in 2017, the Fed had 3 hikes. 2018, they had 4 hikes. After the third hike in 2018, Powell is asked in kind of like a off the cuff manner, where do you see the neutral rate? And Powell, offhand, says it's a long way from here. It's a long way off, I think was the exact phrase. And in short order, it was like October 3rd, 2018, equity markets just immediately start to spill over. Because at that point, the implication that the Fed was going to continue hiking whilst in the midst of QT, it was almost like it was too much to bear. The Fed ultimately ended up hiking again that year in December. And then when they did so, in the dot plot matrix, which the Fed has been using to manage expectations, they said 2 more hikes in 19. It didn't. That didn't last very long. Stocks spilled over. They eventually bottomed out on like Christmas Eve, the day after Christmas, 2018. But ultimately, what ended up bringing this back to life was Richard Florida, who came out and said, guys, we're not committed to any hikes. That was just in the dot plot matrix. That can change. And it did. And so the 2 hikes that they forecasted in December ended up becoming 3 cuts in 2019. And that, to me, is illustration of just how important the wealth effect is to the Fed. I mean, there's going to come a point when falling equity markets are going to become problematic for their monetary policy or for their monetary policy expectations. And that's the crux point that we might be a lot closer to than many expect.
Thank you so much, James, for all your wonderful market insight. And do remember to join us on Wednesday evening for the live coverage of the FOMC interest rate decision, which will be brought to you live from New York by Christopher Vecchio from DailyFX.